This is Marty Hibbs from Grain Farmers of Ontario, and welcome to our fourth lesson in this webinar series. Today, we're going to take a little bit of a different approach. We're going to look at a couple of things that are not really associated with the actual markets themselves. We're going to be looking at the brokerage firm's role. If you're doing trading on futures contracts, you're going to need to be involved with a brokerage firm. So we're going to lay out the roles for the firm and exactly why we need to deal with them. IIROC is the governing body in Canada for any kind of an investment vehicle, and they basically run the show. All the rules are through IIROC, and any penalties of any kind imposed on any kind of firms or brokers are also through IIROC. We'll go into detail a bit more about exactly what they are. The third feature would be the CIPF, which stands for the Canadian Investment Protection Fund. And that one is interesting in itself because being a Canadian and having an account with a registered company in Canada, you do have a certain amount of protection, okay? Then we'll get into opening an account, and that's a bit of fun. We can look at the different types of accounts that we're going to be opening and which one's good for you and the paperwork and see exactly how you get set up so you can start doing some trading. Finally, or the next in line would be the margin. Margin is basically the amount of money that you have to put up for these trades, and it varies, but margin is basically a leveraged play, which means you don't have to buy the entire commodity that you're dealing with, and it helps out with regard to cash flow. We'll look at that as well. Then we'll get into your first trade and how you actually put it on or enter it. And then we'll look at the different kinds of orders that you can put on because it's not very straightforward as far as you just don't phone and buy something or sell something. Depending on what you're trying to do here, there's a lot of different kinds of orders. We won't go through all of them, but we'll go through some of the ones that are pertinent and necessary for, especially in the beginning, when you're not familiar with the market, you need to know what type of an order it is so you don't double up or buy something when you should be selling it, okay? So later on, what we'd like to say is if you have any questions, we'd be more than happy to answer them. But again, we'd like to stay on topic here. So if they're pertinent to the topic that we're on right now, by all means, type them in the box. And either Michael or Megan here can direct them to me, and I can see if I can clarify them, because it's important, you know, that you understand as we go through what we're talking about. Don't be shy, because there's a lot of people that have never done it before, and it's important that it's clear and that you understand the concept, okay? All right, so the brokerage firms and regulations by IIROC. Brokerage firms are necessary to open an account. So if you're going to a bank, the bank is the institution, they hold your account, and you have open a checking or a savings account. It's very similar with when you're trading commodities. It's very regulated in Canada, and you have to trade through a brokerage firm. Now, as you can see on the slide here, there's more than 250 brokerage firms just in futures in the US alone. Futures in the US is a huge business, and there's so many firms online, private, institutional, there's different kinds of brokerage firms. But in Canada, the last count I saw, there was about 6 firms that are licensed to trade futures. And I'm not sure whether it's not because they're just not interested or they don't have the capacity or the volume. But there are companies in Canada that you can trade with, and we'll go through them. We have a couple that are online, and a few of the banks still trade with futures. Now, it's changed since I got in the business, because when I started in the business, it was probably about 20 different firms that I probably worked for. And they just one by one went by the wayside. And today, as far as I understand, there's not too many that are still licensed to trade in Canada. And then again, we'll touch on the CIPF insurance and how it relates to you. It's changed quite a bit since I got in the business, but we'll go through that as the slide approaches. So IIROC stands for the Investment Industry Regulatory Organization of Canada. That's quite a mouthful, but it's a national self-regulatory body which oversees all investment dealers and trading activity on debt and equity marketplaces in Canada. That means that if you're dealing with some kind of a brokerage firm or trading stocks or trading commodities or trading futures contracts, derivatives of any kind, you need to deal with a firm, because if you are not dealing with a firm and some guy calls you up in the middle of the night and has a great deal for you, then you're probably in trouble. So I'd stay away from that, okay? You need to find a company that deals with exactly what you're looking for. And a lot of you people, I'm sure, already have retirement funds, and you have stock accounts and things like that. So it's the same idea, except all investment firms don't trade futures. There's a limited few, okay? So again, the Investment Industry Regulatory Organization of Canada, or IIROC for short, is the governing body. So if you have any issues with regard to, you feel you've been sold a bill of goods, or any complaints about dealers you've dealt with, shady characters or whatever, IIROC is the company you turn to, or the agency, I should say, and they deal swiftly with any kind of, let's just say, irregular activities by brokers. And if you can go online actually and look, and if you have a broker you're dealing with, you can Google his name in IIROC, and you can try mine if you want. But if you go back and see any kind of black mark that they would have, since they've been in the industry, would be on their site. So any kind of issues with being peddled something that you didn't want, or oversold, or put in a position, IIROC is the people you deal with. So again, because we're dealing with Canadian investment companies, we want to make sure that they are a member of IIROC. That's very important. Excuse me, I do have a bit of a cold, as you can probably tell, so I'm trying not to cough here, but I will limit it as much as I can, but it's tricky. Anyway, next in line is the CIPF. CIPF stands for the Canadian Investment Protection Fund. That's a fund basically set up by the government to secure an individual's assets or money in with the firm. Now, you got to keep in mind, first of all, if you lose money in trading, that's not going to be protected. It's a little bit like the CMHC insurance. People buy CMHC insurance thinking that if they default on their mortgage, that they're going to get their mortgage paid for them. But no, CMHC insures the loan company against you defaulting, and you pay the premium, they get the money. But in this case, it's a bit different. The Canadian Investment Protection Fund protects you as an investor in Canada under certain regulations. And when I was in the business, I started in '85, it was a maximum of $100,000 per person. And that's improved significantly, because now we have not only $1 million protection for clients, but there's different categories, and we'll go through those as well. And of course, the segregated funds just simply means when you put your money in an investment firm, it doesn't, unlike our government, go to a slush fund. It goes into a segregated account, and those monies are not included with the company's monies. They are segregated, and they're your funds, okay? So here we go. Who qualifies for the CIPF? If you meet the criteria below, you're eligible. So basically, when you say criteria, you have to have an account with a member firm that is disclosed in the records of the firm. So that means, again, it has to be a Canadian firm, not a US firm. And it has to be on the records that you do have an account with them, and it's got to be disclosed. So that's number one. That has to be, they have to be qualified under the CIPF, okay? The member firm has to be insolvent. So basically, this protection is in case a member firm goes bankrupt. And there's been many, and I've worked for quite a few, actually. There was, I don't want to bore you to death, but I'll give you a quick story. I worked for a company called REFCO Futures, which was the largest futures company in North America. And back, I believe, about, I'm going to say 88, 89, we have a company called REFCO Canada, which is the Canadian arm. And I had clients come to me and open an account and say, Marty, why can't you match their commissions? Well, the US are notorious for slashing commissions. You could trade down there for maybe $15, what they call a round turn. And I had to charge 40 or 50 because my firm wanted 30, and I had to make a living as well. So a lot of people decided they would go south of the border and trade either online or with these US firms. Now, first of all, it's illegal because there is a deal that Canada has with the US that we cannot open US accounts, and they likely cannot open Canadian accounts. But of course, we know that's a one-way street, right? Canadian regulatory bodies are pretty anal, so we were not allowed to open US accounts. But of course, everybody I knew from Canada went to the US and opened an account down there. Excuse me. So anyway, to make a long story short, 1988, I believe, was the year Refco went bankrupt. When they did, it was a shock that was heard around the world because they had global offices pretty much everywhere. So when the dust settled, they found out that anybody in the US lost all their money. They weren't protected in any way. But if you were smart enough to stay with Canada and have an account with refco.ca, your funds were protected up to $100,000. And when the dust, as I said, settled, what happened was they found a few crown jewels that a company by the name of FM Global or Man Financial, which was around since the time of Napoleon, it's about a 200-year-old firm from Britain, stepped in and they bought out Refco. And the reason they did is because it was intact and it was a little jewel, and they bought it up and they moved on for a while. And ironically, the 200-year-old firm finally themselves also went bankrupt. But just to show you that if you are trading, I know it's wise sometimes you want a deal. You might decide, I think I'd rather deal with the US firms because they're cheaper. The problem is you are not protected under their act, and if anything happens, and let's face it, they do business completely different than we do, there's a good chance that you will never regain any of your money back. So again, going back, make sure the firm you're dealing with is under the Canadian Investment Protection Fund and that they're a member of IIROC in good standing. And that way, at least you can go to bed at nighttime knowing that if the company fails, that you do have some protection. So the last part here says the firm as a result of its insolvency has failed to return or account for property it was holding on your behalf. Now, I could get into more detail about that, I won't, but basically what it means is that if you bought stock from this company and they have it in their safe and they're holding it for you and they go bankrupt, then that has to be repaid to you in somehow, remuneration. If, on the other hand, you buy the stock from them and they delivered it to you as a stock certificate and you have it in your basement, then obviously you're not going to get paid for it because you have the valid bearer certificate for the stock. So there's no accountability on their part. But it's more, a lot of people don't take delivery of the stock certificates because if you're a trader, you have a tendency to tell the company just to hang on to it. They keep it in their vaults. And when you're ready to trade it, you don't have to remail it back to them, okay? So that's the Canadian Investment Protection Fund. Now, the limits for individuals have changed over the years. As I said, it used to be $100,000 per person. But today, for an individual holding accounts with a member firm, the limits on the fund are generally $1 million for all general accounts. And that includes things like cash accounts, margin accounts, and TFSAs, okay? So that group of accounts is secured up to $1 million. So if you had 1.5 million in a combination of all these accounts, you're guaranteed to get $1 million of it back, according to the government. A second set would be registered funds, and this would include RSPs, RIFs, and LIFs, okay? So that was a different category altogether. And again, that's combined together for another $1 million. So it has expanded quite nicely over the years. And then finally, there's $1 million for all registered education or RESPs, where the client is the subscriber to the plan. So they have three different broad categories there. So in theory, you could be insured for up to $3 million with the CIPF, and that's a long way from the 100,000 total that they had when I started in 1985, okay? Okay, so the CIPF basically covers missing property. This means property held by the member firm on your behalf and is not returned to you. And it can include cash, securities, futures contracts, and segregated insurance funds. And again, they have to be holding it. So if you have obviously a futures contract with them, they're holding it. If they have cash, they could be holding it, or you could have it. But securities is the key one here, because a lot of securities are delivered to their members. And again, if you take delivery of it, it's yours, you have it. It's only when they have it and they don't deliver it for some reason that you are insured, and any kind of segregated funds. Some of the things that the CIPF does not cover would be, and it makes a lot of sense, losses resulting from any of the followings: a drop in value of your investments for any reason. So if the stock market took a big hit and you go, wow, I lost 100,000. No, that doesn't count. You don't get that back. That's called stupidity or bad investing advice. Investments that weren't suitable for you. Now, this is a gray area, but when you open a trading account, you have to be qualified to a degree. They ask you questions. And let's give you an example. If I was a broker in Toronto and some 85-year-old gentleman came to me and said, I want to open a futures account, I heard you can make a lot of money at it. And his net worth was maybe, let's say his net worth was $200,000. And I allowed him to put $25,000 or $30,000 or $40,000 in a trading account that he's never done before, that it's high risk, that could be construed as misalignment. So in other words, there's a really good chance, probably 90% chance, that that gentleman went to my firm and complained that I would be probably fired or at least heavily fined, and he would get all of his money back, because it has to be a suitable thing for you. If they can prove that, hey, I'm an older man, I don't have an income, I have no business trading commodities, and the firm will totally agree with them. So in this case, you could probably get it back. But again, it says investments that were not suited for you, okay? Misleading information that was given to you. Information that wasn't disclosed. Like, all these things are all just different areas that they have to look at. They're individual, right? Or poor investment advice. If I told a guy to buy hogs because I figure the price are going to go up, let's say China's killing theirs and they're going to buy ours. I mean, that's pretty lame and that's pretty straightforward, but my reasoning in my little mind might be right, but the guy buys it and he goes, well, that was a dumb thing to do. Poor investment advice. He could probably get some money back for that, but there's a good chance that he wouldn't, because he listened to my advice. So, you know, everything is different. I may get fined for it. He may get it back from the firm, but the CIPF would not cover it. Okay. Securities held directly by the client. We spoke about this. This means that you have the certificates on hand, that you're not going to get your money back. You have the certificates. You haven't really lost anything. Okay. So it's just common sense things that they're not going to do. If you lose money, bad advice, or gamble, or do things that you shouldn't do, or day trade in and out all day long. You know, they see like 200 trades in a month on your account. There's a good chance you're probably not going to get it back, because again, that's not what it's for. It's for an investment, a long-term, for people that are legitimately saving for their savings account to retire. It's not for high-stake gamblers. Okay. So I think the CIPF, we've probably belabored that enough. So now let's look at the possibility of opening a trading account. And again, a trading account is a necessity, because if you're going to use these markets in any way to hedge or even to speculate, you have to have this trading account. So once you've decided that you found the firm you want to deal with, you might have a broker that you've spoken to and that you've interviewed and that you feel comfortable with, or maybe somebody recommended this broker. Then at that point, you could probably go ahead and do the paperwork to open the account. Now, there's so many different kinds of accounts, as you can see on this thing here, different types of accounts and different kinds of accounts. Individuals, which could be you or me. Advisors, which are people that advise other people. I have trading accounts where they trade other people. Institutions, which trade with other people's money, and they trade with things like the ETFs, and they have like our firm trades with an institution, because they take our money in our pension plan and they invest it on our behalf. So there's so many different kinds of accounts. Okay. Some of the different types of accounts, there's options. That's a separate account from futures. Forex, which is to do with the currency exchange. Stocks, which are equities, and there's different stocks as well. There's over the counter. ETFs, or exchange traded funds, or another type if you want to trade them. Bonds, and then there's a single worldwide universal account, which basically means that you can trade anywhere on the globe, any of the major exchanges. Okay, so there's a bit of something there for everybody, but we need to narrow it down to see what we're looking at as far as what kind of a trading account the average farmer that we're dealing with today would be looking at. Okay, so again, opening a trading account, we have to determine the type of account we want. And in this case, we'll go through it. It would be either a speculator, because I want to try and make money off the market, or a hedger. Okay. The hedgers need special paperwork. And the reason being is because they're not doing this to gain money from the trading. They're doing it to protect their assets and protect their money, lock in prices. So because they're doing it for that reason and it's tied to their farm or their business, it's an arm of their business, an extension. So in that case, it's not a standalone account, it's tied to their business. So at the end of the year, the accounting for the hedging fund profits or losses would be tied into the firm, okay? And sometimes by doing a hedging account, they also get preferential treatment for, maybe sometimes they'll get a better rate for their commission if they're doing some volume. And sometimes they'll get okay, I lost it, what I was going to say there. But anyway, they'll get possibly commission might be reduced, okay? And then we'll discuss margin also. That's important because most trading accounts are margin. So we'll go into detail with the types of accounts, tax implications for each, whether it's a speculator or a hedger, and whether it's a margin account or a cash account. And when futures, we're usually dealing with a margin account. We'll explain the difference. Okay, so the type of account, speculators are basically individuals or companies that are trading for capital gains. So they have a reason to believe something is going to go up in value. They don't own it. They're not trying to protect it. They just feel that the price of something is going to either increase or decrease. If they feel, for example, that Tesla Corporation was overpriced, they might want to short the stock, meaning they sell it with hopes of it going down. But if it doesn't, they can lose their money on it. And that's a risky trade. So that's a speculator. He's speculating on the price, hoping it's going to go the way he wants. This means that they're willing to take on the risk for rewards. Whereas the hedgers, on the other hand, don't want risk. As a farmer, you want to lock in your prices and be sure of it. The other side of that trade is somebody that's saying, hey, I'll take the risk. So what they're saying is, I will take the risk that you're trying to sell. They think corn is going to go up. You're protecting it from going down. They say, I'll buy your contract. They don't do it directly. They do it through the exchange. But in fact, they're taking the other side of your trade. For some reason, they feel corn is going to go to the moon for whatever reason, ethanol, weather, who knows. But they are looking to win money, and they take the long position, whereas the farmer might be locking in his price, okay? So those are speculators, and the speculators will pay a tax on capital gains at the end of the year. Excuse me. Hedgers, on the other hand, their paperwork need to reflect their company's profits and losses. So what may appear to look like a large loss on paper for a hedging account is really not. What they've really done is they have made money if, let's say they shorted the contract and it dropped, but at the same time, they've lost on their physical product. So what they've made on the futures contract will simply offset what they've lost on their physical. Or if they lose on the paper contract, it'll simply offset the gains that they made from the physical. Does that make sense? Yeah. So basically, they're doing it to eliminate the risk. So again, the two types of accounts, speculator account or a hedger account. So again, tax implications. So as far as I know, unless it's changed, speculators are taxed on capital gains on 50% of the profit. So if I make this year $10,000 profit trading commodities, and I can show that I'm a trader, actively trading, then I will pay tax on half of that at my current tax rate. That's how capital gains is being treated. And a hedger, of course, is not. They're treated as a combined accounting with your business, not treated independently for capital losses or gains. Because again, what may appear to be a capital gains initially is really just offsetting the losses that you've had on your physical product because they're going in opposite directions. Okay? So that's the tax implications for those two different kinds of accounts. Margin accounts, and we're going to get into detail a bit about what a margin account is. Basically, margin is like a goodwill deposit. You can almost look at margin the way you do when you're buying a house. If you go to buy a house today, they don't want $600,000 down payment. They want a small margin of skin in the game. So that's why they require 5% or 10% or in case 20% down. The idea is that the market will move and you have to have enough in there to be able to withstand any volatility or swings in the market, okay? But you don't have to have the full amount. So take, for example, a contract of corn. If corn's at $4 and the contract's 5,000 bushels, The contract's value is approximately $20,000. To go buy that much corn, you'd need $20,000, but yet with the futures contract working under margin, they may require only 5% of that value, which would be $1,000. So for $1,000, I could buy 5,000 bushels of corn. Okay. But now the way it works there is every day it is analyzed, and it's called marked to market. At the end of the day, we look at your account, we look at how much for the day you're down, how much you're up, and there's a photograph and it's shot. And at that point, they decide you've lost $400 today, so you need to cap up the account, that $400 tomorrow. Or today you've made $400, so you're in good shape. So now you have excess margin, which you could either leave there in case you lose it, or you could possibly add another position to your account, because that margin that you make on paper is actually worth money and it's really your margin. Does that make sense to you? Okay. So again, it's a good faith deposit on an amount of capital one needs to post deposit or control. So for every corn account that you want to buy, the minimum margin may be $1,000 initially. And then from there, they watch it each day to see if it's moving up or down. And if you start losing your $1,000, then they get what they call a margin call, which means you got to top it back up again. Okay. So the futures markets actually allow participants to participate in these trades for as little as 5%. So that's pretty impressive. But again, it's almost like the houses with the banks. The bank has a mortgage on your house, but they know the house is bricks and mortar, and they're not too worried about it. They know it's a tangible product. Likewise with these contracts are based on contracts of corn or wheat or soybeans or crude oil or gold. So all they're looking for is a bit of skin in the game so that you don't take off when things get rough, okay? So that's basically the way margin works. Now, margin is basically a performance bond, and again, it can be in the form of cash, or you can even use T-bills in your account to support margin, okay? There's two types of margin that we get. Excuse me, I'm just going to cough for 1 second. Sorry. Okay, so initial margin means the initial amount that they require for you to open a trade. So if you're opening your first trade and you're trying to buy corn and the initial margin set by the exchange is $1,000 US, you need $1,000 minimum in that account to open that trade, okay? Now, the second kind of margin is called maintenance margin. And in that case, what happens is when your margin level drops by a certain percentage, a red flag goes off. And this is called the maintenance margin level. So we're going to use the number $600. So the first day you put your position on, corn drops $400 in value. At the end of the day, you look at your account and it's dropped $400, which is 8 cents, right? One contract dropped 8 cents. So at the end of the day, you bought corn and it's down 8 cents. So 8 times 5,000 bushels is $400. So the person that looks after the margins at the company looks at your account, and the only money you have in there is that initial margin you put in. You only put in the bare amount. It was 1,000. You've now hit a thing called the maintenance margin level. At that point, you'll get an email, text alert, or smoke signal saying, hey, we need more money now. Now, usually it's not quite that way. You usually have arrangements made with your bank, or you have more money than you need in your account. But if that's not the case, what happens is you get an email saying, okay, immediately this has to go back topped up to the initial margin. So now from $600, you've got to put in about $400 pretty much right away. Years ago, before they had the technology they have today with bank interact transfers and all that, it got a bit messier, because what happened is if you didn't meet the margin call right away, you would be closed out. Because what happens is if you don't have that money in the account and that money goes below the margin, somebody is on the hook for it. And it's not going to be the firm. The first in line is the broker. And that broker is making maybe $30 commission off this trade. And the last thing he wants to do is eat $1,000 loss on your account. So for that reason, years ago, the way it worked is if the margin wasn't met by the next day and the market still looked like it wasn't doing well, and he didn't have a reputable, in other words, he didn't have a really good relationship with you. Now he says, I know Joe, he's good. He'll have it here, no big deal. But if he didn't know you and you're just in there on skinny, and it's the margin is at $600 and you don't have it and you can't get a hold of you, then that's going to be blown out and you'll take that loss. And that makes perfect sense, right? And then of course, the next thing that we talk about is leverage. Let's go back there. So leverage, the way it works is quite simple. Again, what leverage really does is it allows you to control a lot of product for a little bit of money, given the fact that the product that you're controlling is a tangible product and it does have value. So the margin really just allows for the normal day-to-day fluctuations in the price. And for that reason, they can do that and they can allow you to trade. Gold is $1,200 times 100 ounces, $120,000 worth of gold. You can control that gold for about $3,000 or $4,000, very small amount of it, okay? But again, maintenance margin means once you hit that level, right away you top it back up to the initial margin. So the two types of margin, initial, which is the amount you need for each and every contract you open, and the maintenance is the accumulated amount that you need. So in other words, without getting too confusing, let's say you have a few positions on, and one position has excess margin. That margin can be used for the corn that's getting the maintenance margin. So the total amount in that account is what counts, okay? So does that make sense to you? All right. So if I'm making on one, losing on the other, the bottom line is as long as it flattens out that I got enough in the account to cover all the margins, we're in good shape. All right. So again, the initial margin is the percentage of the purchase price of the contract that the investor must pay with his own cash to cover the possible adverse move in the market. And the initial margin requirements are set by the exchange, and it's sometimes called the initial margin requirement, okay? And we may get a chance later to discuss, I can't remember if it's in here or not, what affects the margin price. But if I don't, maybe you can remind me later, because these margins aren't set in stone. They have to do with a lot of different variables in the market. So today it may be 1,000. In a very volatile time, it could probably be a lot more. The maintenance margin, again, is the amount of money necessary when a loss occurs on that position, requiring one to allocate more funds to return the margin to the initial margin status. So again, if the margin on a corn contract is 1,000 and the maintenance margin is 700, as soon as you've lost $300, you're going to get a call to bring that margin back up to at least that $1,000 level. Okay, so again, some of the leverage benefits are here. This is an example of, again, these aren't up to date, 2018, and they change all the time. But the contract was corn. The initial margin was 900, maintenance 550. The value is 17,500. Now, what that means is if you take the price of corn and multiply by the contract, the value of that contract at that price is $17,500 for 5,000 bushels of corn. So when you do the math, that equates to about 3.5% of the total value of the contract is all that's required to trade that contract, okay? And again, soybeans, 1,500, maintenance is 11, and the value of the contract is $50,000 at that time. That means the soybeans were probably around $10. But when you do the math, it works out to about 3 to 4% that you need in your account to buy or sell a soybean contract. And wheat, 1050, 750 is the maintenance. Value of the wheat was 22.5 at the time. About 4.5% is the 1050 to trade that contract, okay? So basically leverage reduces cash flow requirements. So if you're a farmer, you have a lot of expenses and you want to protect your crop, you don't have to cough up all of this money to sell it. You can use the margin requirements on the futures to lock in your price for a very small amount of money without being cash strapped. So we're going to go through mark-to-market. And again, mark-to-market means basically, in a nutshell, that accounts are settled each day like a snapshot photo. So the market closes today. Each account is analyzed, but just as a snapshot. So account balances will show at the close of day where they were. Now, this is a moving target. So in other words, what you see could be different tomorrow morning. So it's only a snapshot as of today, what your account balance are, because the minute the market starts trading again, of course, it's going to trade. It shows a snapshot of positions with profits and losses on each one. Now we know, again, that's a snapshot because the minute the market opens, beans could go up, corn could go down, crude oil could go up. So everything changes. And again, it's showing your positions so that you go, wow, I'm short of corn, I'm long of soybean, I'm long of wheat. And you confirm it. You can see it at the end of the day when you get your statement. You know exactly where you are. You see, I'm losing this much on corn. I'm making this much on wheat. So you know exactly where you are. And it'll show your total margin requirement might be, let's say, $4,000. But given your profits and losses at that point in time, it could be $5,000. So in other words, you have excess margin overall. And you can wait till the next day for the markets to open and start back all over again. I'm going to go through a trade here just to give you a clarification of margin, exactly how it works. So try and bear with me here. We'll take it one step at a time. So we're going to deal with a corn contract, your very first account, okay? The initial margin required is $1,200. So we're only going to put in exactly what we need, okay? So day one, we deposit $1,200. Your account balance is $1,200 and your margin position is $1,200. Next day, we sell the corn at $4 right at the close. Now, $4 corn times 5,000 bushels means the value of that contract is $20,000. The account balance is still $1,200 because nothing's moved. The market's closed. It's still at $4. We sold it on the close. So you're good. The next day, because we shorted this market, we want it to go down for whatever reason, whether it's to protect ourselves or to make a profit. So the third day, corn closes at $3.90. Now that's a loss of 10 cents per bushel times 5,000 bushels is $5,000. True. So that means the value of that contract right now at the close of this day, it's only worth $19,500. So if I wanted to buy it back, I could buy it back for $19,500, which means I would have made a $500 profit. Okay, but if you move across from 19.5, you'll see now that your account balance is showing 1,700. Now, it's a floating balance. In other words, it's not closed out. If you were to close it out now, and you can't because the market's closed, it would be valued at 1,700, which is the 1,200 you initially put in, plus the $500 that you're making on number 3, because the corn has moved in your favor 10 cents or $500. Does that make perfect sense? All right, so day number 4, corn drops to $3.70. Now that's a 20-cent drop or a $1,000 profit because this gentleman is short. He sold the corn. So he's doing very nicely. Now, if you move over to the right side, you can see his account balance, its excess is $2,700. $1,200 of that is from what he put in. The other $1,500 is what we call paper profit, or $1,500. Okay. Day number 4, oops, corn bounces right back to $4. At the close of the day, I get my statement. It shows the value of the contract today for me to buy it back is now $20,000. So if I go to the right side, I can see there's no paper profit anymore. It's all gone, but my $1,200 is still sitting there waving at me. Day 6, corn goes to 405 on the close, which means now it's going the wrong way because I'm short this contract. So that's $250 loss. Well, if you go to the right side, now you see my $1,200 I have in there is down to $950. That means I have access only to $950 because on paper, I'm losing $250. Okay. Next day, corn closes at 407. So now that's another $100. So to buy that contract back today, I would lose $350 because I sold it for $20,000. Now they want $20,350 to buy it back. So more importantly, I go to my margin and I'm now sitting at $850, which means if I close my account right here, I would lose $350 and I'd only get back $850 because I'm losing $350 because it would cost me $20,350 to buy back this contract. Good? All right. Next day, wow, 412. So the corn's still going in the wrong direction, at least for a speculator. So now he's down $600. So the buyback that contract today is $20,600. I get a margin call. Why? Because you see there, it says margin position is less 600. If you look up the top, as soon as I broke through 800, I had to get a margin call. So right away, I get an immediate call from my broker. He says, we need $600. So we've made arrangements. I wired it to him, blah, blah, blah. Okay. So then the next day we deposit $600 or that day. So we're still out at a loss of 600, but because I deposited six, I'm back to $1,200 on paper. So I still have my $1,200 now margin in my account, but on paper, I'm losing $600. Make sense? All right. Day 9, corn drops back to $4.10. Now to buy back my contract, I could buy it back for $20,500. So now that means I've gained $100. And if I move over to my account balance, you can see there, we have now $1,300 in my account. The 1,200, right? Plus the 6 is 18, less the 500 that I'm losing on paper. And then finally, the last day, corn goes right back to $4. Okay, I decide I'm getting out. I had enough. This is too risky for me. So I buy back my contract exactly where I sold it for $20,000 or $4. And I look in my account and lo and behold, there's my $1,800. The $1,200 I put in first and my $600 I put in last. So you see there, nothing is moving on that margin account, only losses that are really implied when you close your position. Until then, you're funding or feeding the account balance until you decide to take your loss. So I got back all my money. I got in at 4, wrote it up, wrote it down, got back out at 4, and got back all my margin money. Okay, any questions on that? Anybody got any questions on the computer there? Okay, moving forward here. All right, so the mechanics of placing an order. Now, we're not going to get through all these slides today. We'll do a couple of more and then we'll continue on in our next session. And hopefully the next session will clean a lot of this up because we're planning on getting into the options, okay? So first of all, if you're looking at placing an order on whatever futures you're dealing with, whether it's crude oil, gold, live hogs, live cattle, you have to determine the month because again, with futures contracts, there are many different months you want to trade. And depending on what your purpose is, if I'm a speculator, I would want to go with a month about 3 to 4 months out. Why? Because that's where the volume is, that's where the excitement is, that's where the action is, that's where all the liquidity, so I get my best fills. Now, if I am a corn farmer and we're in February, I don't want probably a March or a May contract 3 or 4 months out. I'm concerned about what it's going to be like when it comes out of the ground. And if I'm trying to protect my corn, I need something going out to the fall because that depicts the fall price of corn as opposed to something 3 or 4 months out. So you see the difference in the two? A speculator would pick a month up close. A farmer or a hedger would go where he's concerned about locking it in. Until that crop comes out of the ground in the fall, he is at risk of losing money unless it's hedged. So to go out that far and look at the price because he locked it in at a certain price, that's what he's concerned with. So again, you determine the futures month that you want to trade. That's number one. You determine whether it's a long or a short. I'm going to go into detail on the next slide. You determine whether it's an open or a closed position. Next slide, we'll get into that one. And then you determine the price. Now the price, you have to have an idea. If you're a speculator, you might be using some kind of a technical analysis to enter the market, or you might be trading on news, or you might be trading on the old top or the old bottom, but you have to come up with a price, okay? Or you have to determine the order type. There's many different order types, probably 20. We're going to go into 3 or 4 types. And then finally, when you do all of this, if you're dealing with an agent, one of the most important things you do is you have that agent read that order back to you. And the reason being is because it's so easy to put an order in backwards or upside down, and you end up, instead of getting out of a position, you end up doubling your position. So in the beginning, especially if you're a new trader, one of the worst things that one of the scariest parts is when you don't know what you're doing and you're trading yourself online, you could double up your position without knowing it because of the terminology, okay? So, long, short. So, every time you open a contract, you got to remember this. There's two sides to a contract. Your obligation is to close out all your contracts, which means every contract has a buy and a sell. True? So if you buy something, you got to sell it. If you sell something, you got to buy it. The beauty of this market is I can sell something first and buy it back. And how I would do that is quite simple. If I believe a stock or a commodity is overpriced and I feel the price is going to fall and I feel that $14 soybeans are too expensive, I can phone my broker and I say, I think these things are coming down. So I can say, sell me one contract of soybeans. So that goes in my statement that I have sold it at $14. Now, before that contract expires, my only obligation is to close out that contract. And that simply means if I sold it, what do I have to do? Buy it back. So if I bought the contract of beans, I have to sell it. It's real simple. So if your initial order is to buy something, like I'm buying beans or buying corn, you're going long the market. Okay? So when you hear somebody long the market, it means that they bought it, they own it, and they anticipate for whatever reason, whether they want to, whether it's hedging, that the price is going to go higher. They are long that contract, okay? But they own it. Selling a contract, on the other hand, initially as the first trade is called shorting the market. And when you short the market, you have to buy it back to offset it. This is called offsetting. So if I sell gold to somebody at $1,400 and it drops to 1,000, and I'm going, yeah, I'm making lots of money. Well, to realize my profit, I have to close that contract, which means I sold it to somebody. Doesn't matter who, because the clearinghouse looks after that. I go in and I buy it back at 1,000. So if I sold it at 14, bought it back at 1,000, any way you slice it, I buy it at 1,000, sell at 14, or sell at 14, buy it at 1,000, I've made $400 profit. Okay? So when you're buying a position first, you're going long that market. If you're selling the position first, you are shorting that market. So selling a contract when you don't currently have one is referred to as shorting, but to offset that short, you have to buy it back. Now I know it's a mouthful and it's a bit because it gets confusing, but keep that in mind. If your first order is buying it, you're long. If your first order is selling it, you're short. Opening and closing positions. Okay, every trade entry involves an opening and closing position. So a new entry is indicating as an open position. So when I buy my hogs, that's called an opening position. To get out of that, I have to close it, which means I have to sell hogs. If I want wheat to go down for whatever reason, or I think it's going to go down, my initial position is to sell wheat. I am short that position. To close that out, I have to offset it or buy back that position. Okay? Now we probably pounded that enough today, but I'm sure it'll sink in. And if you have any questions, maybe the next time we can go through it one more time. Now, types of orders, I think we're not going to do a whole lot more today. How are we doing in time? Any questions on the board? No? Okay, good. All right, so different kinds of orders we put in. Okay, so there's market. Now, again, there's about 20 different kinds of orders, but we're not going to go through them. There's a market order, there's a limit order, a stop order, a stop limit order, which we won't even cover today, and a stop close. Okay, so let's look at what they are. A market order is executed at the market bid ask. So here's the way I would look at a market order. If I want to get in this market, whether it's to go long, buy it, or to short it, I would go with a market order. Why? That guarantees me to be filled right away, because every market has what they call a bid and ask. Now, in something as liquid as corn, it could be $2.42 bid, $2.42 offered. That means the guy's trying to buy it at 242. Someone's willing to sell it at 242 and a quarter. So we're talking about a quarter of a penny per bushel. That's how liquid that market is. So if I want to get in, I would say, sell me corn at the market, and I would be filled at the lower number. Or buy the corn at the market, and I would be filled at the quarter-cent higher. But I know right away I'm in that market. What I have seen many, many, many times is somebody say, where's the corn? 242. Oh, let's try and sell it at 243. Okay. They phone back 20 minutes later. Where is it? It's at 241. Okay, let's move the order down to 242. Okay, let's do that. 15 minutes later, the phone back. Where's the corn? It's at 239. Let's move it down to 240. And so goes the trade. So if he'd just gotten in the beginning, he'd be in. But anybody that tries to chase the markets usually doesn't get filled. And you end up going in at a lot worse price. So the idea is that if you need to get in this market, don't fight for a quarter of a penny. Get in or get out, because I've seen too many people lose. And it's just like Murphy's Law. It'll never go the right way. Okay. Okay, a limit order specifies the price you want to get in. So if somebody says, okay, listen, we like this wheat here at this price, okay, and we think we're going to hit resistance, let's say at $5, and we're trading at $4.90. This guy's an analyst, and he says, I think we're going to get up around $5. So let's tell you what, let's put an order in to sell a wheat at $4.99. It could be what we call an open order. I won't get into that, but it means the order stays there until it gets filled or until he cancels it. Okay. So he puts the order in, and sure enough, 2 or 3 days later, it hits a price print of $4.99, and it goes through to $4.99 and 1/4. He is now guaranteed he is filled in that market. He got his price. But if the price had never reached $4.99 and gone through it by one tick, he may never have gotten that, and the prices could have dropped 20, 30, 40, 50 cents. And he's still not short the market, and he's still losing. So the advantage of a market order is that you're in. The disadvantage of a limit order is that you're setting your price. That's an advantage. But if you don't get filled, you're not in the market. So you're putting the limit on it and saying, here's what I'll take for it. And it goes in that way. And unless it goes that high, if you're trying to sell, or that low, if you're trying to buy, you are not executed and you're not in the market. A stop order is one that a lot of people should use, especially speculators. So basically, let's say, for example, we are in the soybeans, and soybeans are trading at a support level of around $10. And we are long soybeans, which means we're hoping they're going to go up. We're a speculator. But we know that $10 level for some reason is very crucial. And we look below there and go, wow, if these things break below $10, they could really have a hard fall, because a lot of the people that follow technicals are the fund traders as well. So these traders will come in with big volumes. So what happens is, if I determine that my risk is below $10, what I want to do is put in a stop loss order, just like the name implies, stop loss. I'm long beans at $10.10. They're now at $10.01. I'm going to put a stop loss in at $9.99. This is just an example. It's not real. So if the price were to go through $9.99, your order is filled and you're now out of that market. You've limited your loss, you're out of the market. And if the prices were to continue to follow really, really hard, say down to $9.70, you've done the right thing. You've stopped your loss and you're now out of the market, okay? So I'm not going to go into this, but stop orders can be executed to enter or exit markets. Like, for example, if I thought beans were going to fall, and I think if beans go through $10, they're going down, I might want to say, put an order in for me, please. You know, the guy that got stopped out, I want to get in there, because I believe if they hit $9.99, I want to go short one soybean contract, because I think it's going to fall like a rock. And consequently, what happens is once it hits $4.99, I'm now short the market. Even though I could have done it 2 cents higher, the signal is not there at 2 cents higher because it hasn't broken support. But here at $9.99, in my opinion, it might be the support line. And I'm saying now we hit for $9.99. I want to be short this market. So now you're short the market and you ride it. And if it continues lower, you're making money on the market. Then you might turn around and put a stop loss for yourself above that $10 mark. So we're getting complicated, and I want to stop it there because it can really get confusing, and I don't want to do that, okay? So let me just see what my next slide I've got. Hey, my computer quit. Can you advance it? There we go, price limits. Okay, good. We're going to stop there because price limits is a whole different topic. So before I go, again, we're going to have the other 3 episodes that we've done organized in the next couple of weeks so that you can go back and dig through the ones we've already done. And the next one, as I said, we'll continue on here with this part and hopefully get started on options. Options are exciting for anybody that's trading the markets and don't want to put out a lot of cash, but have the protection as well. So unless there's any questions, guys, you still got nothing?
Well, there's a question that's come in around stop orders.
Okay.
And that question is, if you have a basket of say 100 shares in a company or something of that nature, do you have to sell all of them? Or can you just put a stop order on a percentage?
In that case, if you're talking equities, yeah, you can put a stop order on a percentage. That's called an odd lot number. So let's say, for example, you've got 100 shares of a big company. You could sell 4 or 5 shares, no problem. But it goes in a different group. It's called an odd lot share. So it doesn't go because the shares are usually generally 100 in a lot. But yes, you can. Yep. Does that answer your question, do you think? All right, good. So folks, I guess that's about it. So we've enjoyed this today. So I apologize again about the voice. Hopefully next time it'll be better. And have a great week and good luck trading. And we look forward to our next seminar. Thanks.